So first question is, what is IV? And it's a measure of perceived risk or uncertainty. So as you see, implied volatility go up, what you'll see is then there's nervousness, there's skepticism, there's worry in the market or uncertainty. So the VIX, the VIX, is the volatility index of the S&P 500. So that's most people look at that and say, what's the volatility in the market? But that's just one measure of volatility. And options are like financial insurance. So for those that live in Florida and probably even in Texas, premiums, IV or options are like insurance. The premiums will increase as the risk gets higher. So I live in Central Florida, and we have a hurricane season that kicks in probably around June 1st and runs through October. And as they get a named storm out there, if you went to purchase homeowners insurance, you're going to pay a higher premium because there's a risk out there. And so same thing with, like a financial storm, like an unknown, like CPI numbers coming out, or there's a big Fed meeting that's going to increase risk, and the price of options goes up. The other thing that's pretty interesting is demand for option increases when historic volatility increases unexpectedly. So after the market pullback yesterday, the VIX was up like 25%. So, while the market was down 5%, the implied volatility was up 5 times that. So options are going to really be impacted by implied volatility. So IV is really the value of that volatility as it's priced into options. So when you're looking at an option strike, what you're seeing is what the market makers have kind of built in based on what the price is, what is a fair price for that option. The other thing that IV does, it will calculate the future movement or a trend in the stock. So you can take a stock price, you can take its IV and multiply it, and that will tell you what is the expected 1 standard deviation move. So that's a pretty interesting feature of what IV can do. And so 1 standard deviation move is 68%. It means that 68% of the time it's going to fall within that 1 standard deviation move. And the Black-Scholes model is really the standard in terms of option pricing. So any questions about that so far? Okay, so here's just a really quick, you've seen these 100 times, I'm sure. This is basically the bell curve or standard deviation. So you'll see, 34% on each side makes 1 standard deviation. And then if you're interested, there's a 13.6% takes you to 2 standard deviations. So really, once you get past 2 standard deviations, it's going to cover like 96% of the movement in that particular stock.